Welcome to the Times of Industry show. Today I'm with Ronnie Strafale, the managing partner and fund manager at Incrementum AG. And this guy in 2006, he began writing reports on gold and gained media attention worldwide when he expected the price of gold to rise to $2,300 per ounce when the price back then was only $500. His 6 benchmark reports called In Gold We Trust, which I urge everyone to take a look at, drew international coverage on CNBC, Bloomberg, Wall Street Journal, The Economist, Financial Times. He was awarded the second most accurate gold analyst by Bloomberg in 2011, and currently manages the gold mining baskets and silver mining equities. The website is incrementum.li and inflationdeflation.com. Ronald, thank you for being here.
Hi, thanks for having me. Really looking forward to the interview.
Sure. Look, it's a privilege, and the people that are watching this are taking a look at the screen right now, and they're looking at a chart that you produced, and it's basically a comparison between the gold bull market of the 1970s and the gold bull market that started in 2000. And when we plot this chart, what we can see from your comparison, and I want to ask you this, first of all, is there any reason to deduce that these two time spans deserve a comparison? I mean, the 1970s and the 2000s are very different eras. And secondly, it suggests that right now we're in a cooling off period, and that the next 6 to 7 years hold great gains for gold investors after this cooling period finishes. Do you think this long cooling off time span killed the sentiment? I mean, so many investors are giving up on gold stocks. The volume for the junior mining sector is horrible. Top quality companies see 20 to 40 trades a day. I mean, this kind of volume hasn't been seen in decades. Is this signaling the nearing of the end of this cooling off period?
Yeah, I hope so. I think the comparison of the bull markets of the 1970s versus the current bull market is highly relevant. First of all, the patterns are really similar. I think in the 70s we have seen monetary chaos, but we're also seeing monetary chaos now, especially since 2008. We're seeing that debt was growing quite strongly in the 70s, and it's growing extremely strongly at the moment. But it's also important to compare bull markets itself. And from 1974 till 1976, we had a big correction, a mid-cycle correction. So within every big bull market, basically at the middle of it, there's always a big correction, mostly 50% drawdown. And in the 70s, we had disinflation, so falling inflation rates. People were thinking that the economy is turning around. In my last gold report, I even showed an article from the Wall Street Journal that was published in 1976, basically saying gold is useless, nobody needs gold anymore, the economy is doing so well, unemployment is getting better, inflation isn't a problem at all. And we know from 1976 till 1980, gold rose from $100 to $850. So
similar to right now. That's it's so
yeah.
Exactly. Okay.
So I think at the moment, since 2011, we're also seeing falling inflation rates. We're seeing that economic numbers are getting better, of course, because we're seeing such ridiculous interest rates. We're seeing quantitative easing. We're seeing more and more debt, of course, that has some short-term effects on the economy. But I think that this mid-cycle correction, it basically ended at the beginning of last year, and now we're in the early stages of a new leg up. So I think we're currently in the beginning of this what is called public participation phase. But it also shows, the chart also shows that the duration of both corrections diverges. So the current cycle is definitely longer, and that kind of suggests me that this trend will be significantly bigger than the bull market in the 1970s. So to sum it up, I think gold in monetary terms, because there's so much money printed all over the globe, it's basically as cheap as it can get, and I think we have already seen the lows, and this is a pretty decent risk reward ratio at the moment.
Interesting. Now, on screen, we're seeing a clear-cut chart. It shows the amazing inverse relationship between the S&P 500 and gold investments. Why are they so inversely correlated? Do you think that is what gives gold this great role as a hedge that Ray Dalio attaches to it? And lastly, do you think that in the coming U.S. equities meltdown, when we see, the S&P 500, the Dow, the Nasdaq, when we see these correct back down like they always do after a blow off top, will we see gold stocks sell off like in 2008 with the rest of the market, which was it was an exception and not the rule, or soar like this chart suggests and like history has proven, except for the Great Recession?
Well, first of all, I think every crisis is different. 2008 was deflationary. It was a liquidity crisis. Markets were concerned about the ability of the lender of last resort to actually reflate the over-levered system. I think as the next crisis plays out, there will not be any fear that too little money will be printed, but fear that too much money will be printed. So I think the next crisis will not be a deflationary one, but rather an inflationary one. So I think coming back to the chart, it's showing the GSCI versus the S&P 500. GSCI is a long-term commodity index, and it shows that we're at the same level basically like in the 1970s, 1971, but also 1999 at the when the dot-com bubble bursted basically, and we can also see that we're very, very far away from the median, the long-term median, which is at 4.1. So markets tend to make a mean reversion. So we're on a relative basis, commodities are just ridiculously cheap versus the S&P 500. I think having a look at ratios makes much more sense these days than having a look at absolute numbers, because due to all the monetary interventionism, everything is basically distorted. All the price signals are distorted. So therefore, I focus on relative charts like this one, and it clearly shows you that commodities are dirt cheap versus the S&P 500. Now, coming back to your question regarding equities and mining equities during a crash. Well, if there's a general equities crash, I cannot rule out that gold stocks will crash as well. We should not forget, people always ask me, shall I buy gold, physical gold, or mining stocks? And I say, it depends. What do you want? What do you expect? Are you buying because you want to have safety, you want to have an insurance against financial repression, against high inflation, monetary reform, monetary chaos, whatever, then you should buy physical gold. Then you should focus on counterparty risk, on storage. If you want to have performance gold, if you say that, okay, I'm seeing mining equities that are interesting, I think there's enormous leverage on mining equities regarding gold, then of course you can buy mining stocks, but you should not underestimate the equity risk that they have. So I think within a general market crash, I think gold stocks will have a hard time, but usually they recover very, very quickly. And this is also a main takeaway from the last gold report. I always say that recessions are a beautiful environment for the price of gold, and that's actually confirmed by the numbers. Why? Because gold anticipates that central bankers will lower interest rate, that they will announce another round of quantitative easing, that politicians will introduce fiscal stimulus. So gold is discounting all those measures that happen during recessions, and that's why recessions are a pretty good environment for gold, and that's also the reason why mining equities recover very, very early stage within a recession.
Interesting. Now, looking at the next chart, we see the debt load that the U.S. economy has been able to absorb and handle. Where will this pyramid topple? My view of it is that this can go on for another decade or even more if the interest payments are still below 600 or 700 billion, which are doable for the United States government at this particular point with tax revenue and with limited military spending as compared to the last decades. Do you think, what are your thoughts on this? I mean, where does the rubber meet the road on this?
Well, of course, we can, if, you know, the U.S. debt situation, it can go worse. We're seeing levels that are definitely not sustainable. But I think, you know, coming back to the fundamentals, I think the big illusion of debt redemption is currently only maintained because we're constantly rolling over maturing debt, and as long as interest rates are declining, refinancing costs become steadily more favorable. So we call this time period the lucky time window. We're seeing that basically in Japan, where they have constantly been rolling over old high-yielding debt to lower-yielding debt, but now basically all their debt burden is financed on very, very low interest rates. So if there's only a minor rise in interest rates, this will have enormous effects. So they are already extremely sensitive to rising rates. So coming back to your question, of course, it can go on and the US debt can go to, I don't know, 25 trillion, whatever. But the more debt is rolled over at low interest rates, the more sensitive it will become to rising rates, and probably the more likely we are seeing a crash if rates continue to rise. And we should not forget that actually a monetary tightening basically started in 2013 when Bernanke announced that there will be a tapering. Then we have seen the actual tapering. Then we have seen the first rate hikes, and now we are seeing quantitative tightening. So we are already very, very far within that cycle, and this makes me pretty confident that we're gonna see some sort of market distortions or crash or whatever very, very soon.
Now, Ronnie, we're looking at a chart of base money inflation, and also plotted is the price of gold. Can you explain the significance of the central bank's balance sheets as compared to the price of gold? And let me tie in another question with this one. How has the system been able to absorb all of this stimulus and still function in a very deflation environment, with gold prices actually going down from 1900 to about 1100 in the last 5 or 6 years here?
Yeah, well, what we called, what we're seeing on this chart, we called it monetary surrealism. So we're living in an age of advanced monetary surrealism. So just to give you one number, Leo, we have seen only in the first quarter of 2017, the largest central banks created the equivalent of almost $1 trillion, so 1,000 billion US dollars worth of central banks' money ex nihilo. So, of course, this newly printed money is the main reason why we're seeing all-time highs in equities, in real estate markets, in the art market. We're seeing all those developments, of course, in the crypto space. We're seeing bond prices at or close to their all-time highs. So this, of course, has consequences. But it's important to know that based on the Austrian School of Economics that I very much adhere to, the first stage is always monetary inflation. We're seeing that. The second stage is asset price inflation. We're seeing that. As I've said, stock markets, real estate, bond markets, you name it. And the third stage is always price inflation. So what central bankers usually call inflation. So rising prices is only a consequence of money printing. So since 2011, based on those mainstream indicators that central bankers and economists use, we're seeing kind of falling inflation rates, disinflation. We're also kind of seeing that real rates are rising, and that means that opportunity costs for holding gold were growing, and this was a negative environment for gold. So from my point of view, we're at the early stages of a new age of inflation, of price inflation. And you mentioned Ray Dalio before, and I think he is one of the most brilliant and most successful fund managers ever. And he just recently said the two main risk factors for the average portfolio are less than expected growth and more than expected inflation. So basically, stagflation, a combination of high inflation and a weak economy, this would be a black swan event. This would be something that no investor is basically prepared for. So I think that investors should buy some sort of inflation protection, and I think that mining stocks, but also commodities themselves, they are just extremely cheap, and nobody cares about them. So from a contrarian point of view, I think that's a great environment.
That's very interesting that you bring this up, because moving on to our next chart, to me, reaching a point where commodities are generationally cheap, like portrayed in this chart, it makes sense, because commodities as a group have been made cheaper and cheaper to produce due to technology and synthetic alternatives to many important commodity. But the low-hanging fruit that has been mined in the 20th century has largely gone. And there are fewer geologists than ever, fewer farmers than ever. The real assets, what takes real work to pull out of the ground, is not where college grads want to be and do. They want a tech office, they want a downtown restaurant for lunch, they want a quiet evening at home with... These are forgotten. What happens when the rubber meets the road here, and Asian demand from these emerging markets that have rising middle classes eclipses all of the supply, and we have to facilitate for the growth that will come from these young demographic nations?
Well, you're perfectly right. I think that a bull market is always the consequence of a bear market, and vice versa. And what we have seen in commodities is in terms of the drawdown, the last big bear market was the longest but also the biggest bear market since 1970. So this would suggest that the next bull market, that from my point of view started in 2016, should be longer and stronger than any bull market since the 1970s. So of course, this isn't always 100% right, but we have seen an enormous amount of destruction within the sector. We have seen that so many capacities were just shut down. We're seeing in the gold business there's so many companies just basically stopped doing any exploration for years. Many companies just were closed down and forced out of the market. So we have seen a massive amount of creative destruction, as Schumpeter would have called that. And this will be basically the fundament, the starting point for the next leg up. But I think that the commodities bull market will not only be a consequence of rising demand. It might also be a consequence of monetary inflation and basically fiat currencies devaluing against hard assets. And we have seen that in the 1970s. Don't forget, in the 1970s, we had rather sluggish GDP growth, but commodities were rising big time as a consequence of basically the US going off the Bretton Woods agreements and seeing a massive destruction of purchasing power in the US dollar, but also as a consequence of geopolitical events. And I think comparing the 70s to current times, it definitely makes sense. Also in terms of geopolitical crises, North Korea, we're seeing what's currently happening in Barcelona. We're seeing so many regions, the whole Kurdistan discussions at the moment. We're seeing Donald Trump basically trying to start a war, at least on Twitter, every morning. So I think that from a geopolitical point of view, the world is unfortunately very, very unstable, and this could also be one strong driver for a bull market in commodities.
Well, lastly, Ronald, I mean, this next chart really sums it up for me. It shows the middle class and lower income class have little to do with this experiment, with this wealth effect that we've seen in the last 8 to 9 years, since they can't afford to own equities in the very companies that they probably are employed at and help to manage and run. In the USA, Is the USA going to be a 90% low income and 10% wealthy like the rest of the world? Is the middle class post World War II, that miracle that created middle class America, is it over basically in a few years?
Well, it might be. It's not only happening in the US. In the last gold report, we had a chart showing for the G10 countries, so the most prosperous and the largest and strongest industrialized nations. In the last decade, 80% of the households saw declining real incomes. So average people are not doing very well, and from my point of view, this is the main reason, or the main reason why there's populism coming up in the far right, but also on the far left side. If people would be doing well economically, if their real household incomes and disposable income would be rising, I think they would basically vote for the status quo and not for some populist politicians. So from my point of view, the main reason why we're seeing this massive divergence between the poor and the very rich and the shrinking of the middle class is in our monetary system. Fiat money, the creation ex nihilo, that creates so-called cantillon effect. So if you're an early receiver of the newly printed money, then you're profiting from it. through asset price inflation and so on. And if you're a late receiver, basically those people's living on the countryside, having like very very basic normal jobs, they're suffering from monetary inflation. And this is also the reason why, for example, in financial centers like Hong Kong, New York, London, where real estate prices are ridiculously high, while on the countryside they're getting cheaper and cheaper. So from my point of view, many problems that we're having in our societies can basically be explained by our monetary system. Unfortunately, nobody is talking about that these days, and this is why I'm really very keen on the Austrian School of Economics, that doesn't only give good answers, but it's asking the right questions. And I think that the Austrian School of Economics, from my point of view, is very important, because it not only gives the right answers, but most importantly, it asks the right questions. And this is important these days. I think that many problems that we're having in our societies can be traced back to our monetary system. So I think studying monetary history, studying the Austrian School of Economics is really, really important these days.
Hey Ronnie, I know we said that we're gonna have a part 2 of this, where we're also gonna focus on gold equities and what the charts are saying right now with regards to, as you put it, the relative ratios. And we're definitely gonna do that soon. Where can people check out more of what you guys are doing in anticipation of the second interview?
Yeah, thanks, Leo. I'm glad to be on the show again. Our webpage is incrementum.li. The report that came out in June, it's quite a book, it's I think 170 pages, is called In Gold We Trust. We also got a webpage for that report, it's ingoldwetrust.li. You can download it for free, and I think it's a very interesting read, because we're not only focusing on gold and silver and the mining equities, we're also talking about demographics, we're discussing populism, we are also writing about technical analysis of the gold market, we're writing about the Triffin dilemma, we are having an exclusive interview with Julie Shelton, who was an advisor to Donald Trump. So I think it's quite an interesting read, but you have to take at least 1 or 2 days off, because it's quite some heavy reading.
Well, hey Ronnie, thank you very much for doing this, and we'll see you soon.
Thank you very much, Leo. It's been a great pleasure.